The euro gained value in early trade on Tuesday, driven by upbeat data on economic sentiment and current conditions in Germany and the euro area. The focus of market participants was on US inflation data, which turned out to be mixed. On the one hand, the annual inflation rate dipped to 3.1%, down from a 3.2% year-over-year rise in October. This fact was taken as a bullish signal, sending the euro and the British pound sharply higher. On the other hand, US inflation climbed by 0.1% on a monthly basis. The core consumer price index increased by 0.3% in November after rising 0.2% in the prior month. On an annual basis, core inflation held steady at 4%. All of this suggests that the Fed will keep its policy unchanged and stay data dependent. Therefore, any policy shift at today's meeting is unlikely. In this case, the US dollar is expected to extend gains. As an alternative, if Fed Chair Jerome Powell's statement fuels investor optimism that interest rates have peaked and will soon be lowered, risky assets will probably gain upside momentum. Speaking of the pound sterling, it reacted to UK jobs market data. The number of Britons claiming unemployment benefits rose to 16,000, falling short of an anticipated 20,000 increase. The UK unemployment rate remained unchanged at 4.2%, and average weekly earnings, excluding bonuses, fell in October. Against this backdrop, the Bank of England is widely expected to continue with its aggressive monetary tightening to combat inflation. Let's take a look at today's macroeconomic calendar before getting into the technical analysis. It includes UK GDP data for October. Britain's economy is forecast to shrink, which could weigh on the pound sterling. Besides, the UK will release data on industrial production, which is also expected to be negative. Thus, gloomy statistics will once again confirm the negative effect of high interest rates on the economy. Furthermore, traders may take notice of Eurozone industrial production for October and US producer prices for November. But these reports are unlikely to have a severe impact on market sentiment. After all eyes will be on the Fed's policy meeting. According to the 1-hour Euro-American dollar chart, a spike followed by a false breakout at 1.0799 will create a strong sell signal. If the price rises to 1.0827, its false breakout will also make it possible to open short positions, thus dragging the euro down to 1.0762. In case the price breaks through this level and tests it from the bottom up, with the Fed keeping its monetary policy tight, the euro will most likely dive to 1.0726. Its breakout will open the way to 1.0698 and 1.0667. At these levels, I recommend going long on a rebound to catch an intraday correction of 25-30 pips. Long positions at 1.0762 and 1.0726 can be considered amid a false breakout. Alternatively, if bulls take control of 1.0799 and the Fed takes a soft stance, the euro is expected to break above 1.0827 and then head for 1.0862 and 1.0893. At the mark of 1.0893, it would be a wise decision to go short on a rebound, counting on an intraday correction of 25-30 pips. Going short at 1.0862 and 1.0827 will be relevant only in the event of a false breakout. Meanwhile, the pound sterling is trading sideways. A false breakout at 1.2533 will create a buy signal, thus pushing the British currency up to 1.2569. If the price breaks through and consolidates above this mark, sterling is likely to rise to 1.2609. Moreover, it may surge to 1.2646 or 1.2682 if the US Central Bank softens its policy stance. At these levels, traders are recommended to go short on a rebound to catch an intraday correction of 25-30 pips. Short positions at 1.2569 and 1.2609 can be opened amid a false breakout. If the price fixes below 1.2533, the British pound will slide to 1.2505 and then head towards 1.2478 and 1.2451. This scenario is possible if the Fed remains hawkish. At the mark of 1.2451, one can go long on a rebound, hoping for an intraday correction of 25-30 pips. Going long at 1.2502 and 1.2478 will be relevant only amid a false breakout. Best of luck!